Traders. In this video, I'll start to find the first iteration of the strategy that we are developing. The strategy will be very basic at first, and the idea is to execute more or less 50 trades, review the performance, and analyze the results. This will allow us to optimize the strategy over time to get the best out of it. Now comes the difficult part. Creating a trading strategy is like mixing a gin cocktail. With hundreds, if not thousands, of gin brands, each boasting its own unique flavor profile, and hundreds of mixers and modifiers ranging from tonic water to juices to bitters and soda, along with various types of garnishes and ice, the task becomes daunting to choose your mixes. Considering the multitude of possible combinations, you could end up with close to 1 billion different cocktails. However, most of these combinations will likely yield unpalatable results. Some may be average, while a few will be truly phenomenal. A trading strategy is similar. There are thousands of different indicators or patterns that you can use. Couple this with time frames, trends, specific instruments, and risk strategies. You'll also end up with close to 1 billion different combinations. And, similarly, most of them will fail horribly. Some will allow you to break even, and a few will actually be pretty successful. Now, the great thing about the gin cocktails, which is also applicable to the trading strategies, is that if you take a specific recipe and tweak it using trial and error, increase some components, swapping out others, you'll eventually discover a flavor combination that will blow your mind. If you apply this same process to your trading strategy, you'll hit gold in no time. Okay, let's jump into it. First, let's choose an instrument. There are a myriad of instruments to choose from. Each will have their own characteristics, behaving differently through different market scenarios and impacted by various factors. As a beginner, it'll be easier to trade just one instrument. This allows for a deep understanding of one instrument's price movements, patterns, and behavior, enabling you to develop a more refined and specialized strategy. Additionally, focusing on a single instrument reduces cognitive overload of having to research multiple aspects across multiple instruments. There are a couple of things to consider when choosing an instrument. First is trading hours. Different instruments have distinct trading hours based on the underlying markets. In addition to this, volatility varies over the course of the day and week. Choose an instrument that fits into your personal schedule. You also need to take into consideration trading costs of different instruments such as spread, commissions, and swaps. For this strategy, I'll be trading gold. The two main reasons are, first, I'm familiar with trading gold, and secondly, gold is the most active during the London session and New York session, which both fit into my personal trading day without having to wake up in the middle of the night at odd hours. Next, let's choose the time frame. As a beginner, stick to one time frame to learn the ropes. For more advanced strategies, which we will get into later in this series, it is common to have confluences over multiple time frames. If you are familiar with wave theory, you know that generally it is assumed that patterns repeat across multiple time frames, and you have waves within waves within waves. But there are practical limitations, such as the spread. On smaller time frames, the spread is bigger in relative terms. In essence, then, the smaller the time frame, the more the trading costs are. On the contrary, the bigger the time frame, the longer it'll take for patterns and structure to form. To spell out the obvious here, there's a trade-off between trading costs cutting into your profits and number of trades in a given time period. When you're developing a new strategy, you also want to execute as many trades as possible to have a large sample size that you can analyze. The more data you have in your sample size, the more accurate the results. Thus, I'll go for a 15-minute time frame for now. In the next video, I'll be diving into the initial entry and exit strategies, as well as risk management that we will start off with. Thanks for watching, and until next time.